from London. It's not Saturday night. It is very early Wednesday morning. It is the middle of IE week, and every event is beating all of the records, including Energy Aspect's great event yesterday, amongst a long list of others. Lots of people seem to be keen to hear from all of the wise minds, and we are as well this morning as we kick off our own day of the Middle East Energy Summit here in London, as Brent crude oil trades a little bit sideways this morning, but at least not falling anymore after yesterday. It's at $73.19. So, below that $75 barnacle on a rock where it's sort of the center of its gravity in recent times, on the lower side, minus a dollar or two rather than plus. Let's kick off this morning out there deep into Asia. Clyde Russell, Asia commodities and energy columnist, Thomson Reuters. Clyde, I start with you this morning, I'd say on the demand side of this narrative. Here at IE Week, which I'm kind of bringing to the conversation this morning, more bearish than I was expecting would be the dominant theme here. Last year, a year ago, was all, oh yeah, China's coming back. It's given up on COVID and it's going to save the day. This year, it's the exact opposite. The China story here in London is very bearish. The most notable point on that is that the idea that China's growth numbers, i.e. 5%, is being sort of generally dismissed here as half that number. So China's now growing at 2.5%. You basically cut their numbers in half, and that's where we're at. So Clyde, as the guru on all things China oil demand, China oil imports, your thoughts on how bearish the China narrative is this year, now deep into the second month?
Well, I think we're starting to see from the flows data just what the first 2 months are looking like, and they're not looking that strong for China. So you're looking down from the first 2 months of 24. So we haven't got final figures yet, but we're looking at around 10.5 million barrels a day worth of imports. And that already suggests that the demand forecasts made by OPEC, the IEA, and others are going to, once again prove too optimistic. I've been actually thinking about this quite a lot of late. All those organizations and analysts like to talk about demand, but demand is a meaningless number to the market. What matters are imports, particularly seaborne imports, because that's what drives the pricing. So to me, it's irrelevant that somebody says Chinese oil demand is going to rise by 500,000 barrels a day. If their imports are down by 300,000 barrels a day, that's what matters. And I think, if you're looking at the hard data, their imports are down. They've started the year weak. It's hard to construct a bullish narrative at the moment. The only thing that is slightly bullish is if you actually drill down into the detail of why they're down in January and February, more specifically in February, there's a lot of loss of Russian barrels, particularly of the so-called grade. So if you're going that granular, it's perhaps those US sanctions that Biden put in just before he left office that have actually cut Chinese imports rather than any weakness in actual fuel consumption in China. But that's stretching a fairly long bow, and it doesn't really alter the big picture that China hasn't had a strong start to the year.
Let's welcome Livia Gallerati, Senior Oil Markets Analyst at Energy Aspects. On the demand side, Livia, it's somewhat softer, somewhat bearish. Another data point that I've heard a number of times in London this week, again on the lower side of what one would be hearing before the gathering here in London, is that global oil demand growth at 1 million barrels a day being the kind of consensus number, not 1.3, 1.5, which I was hearing and seeing reported prior to coming to London, but 1 million barrels a day a la Rystad Energy, 1 million barrels a day a la Argus Media. So looking at the demand side, what about supply, Livia? It seems to me that really the focus has to be on supply, and the other part of that narrative is that even from non-OPEC plus countries are offering the world this year more than that 1 million. The supply just from non-OPEC plus is going to exceed the demand growth. Your thoughts on where the supply outlook is as we stand on the doorstep of March?
Yeah, I would broadly agree with you, Sean. I think when we're looking at balances for 2025 in general, the market has been seeing a surplus because, as you say, demand, we've had around 1 million barrels per day as our demand growth forecast for quite a while, and we're holding that. Non-OPEC supply, in theory, grows by more than that. Maybe if you're looking at it on a liquids basis, maybe it's even 1.5. But there's a lot of risks around that. Just thinking about a couple recently, we've seen underperformance again in Brazil and Mexico. Brazil in particular should be one of those countries that adds a lot to the supply pool in 2025. And it's been a very disappointing story last year. It doesn't look like it started this year any different with maintenance and the coming online of new platforms is taking longer than it should be. So I'm not particularly optimistic on that. Mexico as well, we know there's a lot of problems on the upstream that's been really impairing production. That might get a little bit better, but anyway, Mexican production is declining, so not a lot of growth from that. The US is the big story that everybody's talking about. All the conversations I've had at IE Week so far, particularly with some of the hedge funds, macro guys have focused on Trump saying that he will unleash US production. We're not really thinking that he can actually do that. And I think a lot of the
not unless he wants to go out and go digging himself, perhaps put on his overalls.
There is a geology problem in the US. All the best acreage has been depleted. So even with very favorable policy, you actually need very high oil prices to go and drill more. And that's exactly the opposite of what President Trump wants to achieve. If you actually bring prices down by $15, $20, as some of the participants think at the moment, you're actually going to get US production declines.
Let's welcome James McCallum, CEO and Chairman of Exergy Group, Professor of Energy in Strathclyde University. Just sort of following on, so perfectly set up there by Livia. James, let's just start with the industry side of things. I mean, and then within that, of course, there's many places to look. But in terms of, let's start with the US, the idea that regardless of the deregulation and the attractive new maybe concession offerings in national parklands and so forth, how do you think the industry is likely to respond to these opportunities, James, for increased production?
Yeah, well, at best, the industry is currently sitting on the fence, Sean. If you take a look at, there's lots and lots of news out there that sort of drill, baby drill, although there's a quote in your Press Digest today, which I thought was amusing, where Trump apparently is saying he'll drive through this increased production, even if he forces the drillers to drill themselves out of business. Stunning quote. Anyway, the majors are flat in the US in terms of their stock prices, so they're continuing with their dividend policies, the way they have been. They are not doing anything, as I always say, other than sort of recompletions just now. The Baker Hughes Rig Index confirms that in terms of, no significant uptick in terms of the number of rigs that are working on recompletions. And as I always tend to draw the listeners' attention to the sort of like the major service company stocks, Schlumberger on over the last year are down 16%. Halliburton, the big US name on everybody's sort of lips in this particular space, down 25% on a year ago. So the service companies simply do not see increased activity flowing through into their revenues because it's simply not happening.
Well, James, just to follow up on that, from the point of view of sort of broadening it out and then sort of throwing in the pepper sauce of the geopolitics of everything, a deal done on Russia's invasion of Ukraine opens up potentially the opportunity for oil services companies to return to Russia, although Schlumberger never left. What about the rehabilitation there, that the industry goes to work in that very large reservoir region of Russia?
Yeah, look, I mean, the oil and gas service companies, as history will tell us, goes where the activity is. So the point you're making is, do we think that there'll be a huge ramp up in activity in Russia in the very near future? I'm not convinced that that's the case. There's a lot of geopolitical things at play here. Europe is trying to work out, does it have a continuing relationship with Russia in terms of energy supply, particularly gas, yes or no? Does it shift in terms of its LNG supply towards Qatar and the United States? And of course, I'm sure you're in London this week. I'm sure the LNG story is massive in London this week as the world is looking at a huge shift in that marketplace, particularly out of the US. So, no, look, I mean, there's nothing there that would lead you to have confidence. Livia just talked about, you know, the potential of a $15 swing in terms of oil prices. And certainly from the surveys that were run earlier this week, absolutely the vast majority, if not all of your listeners, actually see, you know, sort of like oil prices heading in a bearish trend going forward. That's not a driver for activity. It's not a driver for a wholesale change in terms other than
and certainly
maintain the status quo.
It doesn't help when the President of the United States threatens to put a whole oil services sector out of business. Clyde, I wanted, and I'm just getting a reminder in my ear that this, just for a self-promotion moment, is our 998th podcast, which is very exciting for us because we're going to hit 1,000 podcasts the big 1,000 this week on Friday. So a nice way to wrap up IE week, but I digress. Clyde, what is in the cards in all of this is the redirection of energy flows. One thing that seems to have come out of the flows that redirected after the Russia invasion of Ukraine, and now with Trump really ramping up, you must buy our oil, you must buy our gas if you want us to protect you, save you, love you. What does that mean in Asia? Obviously, Iran flows to China have been dominant, but now U.S. crude into India seems to be. What are your thoughts on, as we move through the year here with the Ukraine deals being solved in some way, that redirection of energy flows?
Well, I think there's obviously a lot of things going on and lots of things to unpack. I think the first thing is that the retaliatory tariffs that China put on US imports of oil and coal and LNG are high enough to kill that trade. So I expect that over the coming months, you will see China's imports of US energy drop to zero or near zero. So that's one flow that is dead.
Which were always quite minimal anyway, right? About 200,000 barrels a day or something.
Yeah, I mean, they sort of averaged around that 250,000 barrels a day. At times, they actually climbed a little bit higher. But at one point, if you're actually looking at LNG, you know, they were supplying up to 10% of China's LNG.
Right.
And I think you're going to find that's gone. And if you actually, I know we're not really talking about coal, but at one point they were supplying about 15% of China's imports of coking coal for steelmaking. So that trade will disappear as well, I expect. If you look at it, Iran effectively only has China as a buyer for its oil. Maybe some other pariah countries like Myanmar is taking a few cargoes. Is that trade likely to continue? Well, how does the US actually stop it? Because they're using their own vessels. So you can't really sanction the vessels. You can try sanction insurances and things like that, but it's probably harder. And it's definitely within China's interests to keep buying oil from Iran. They get it at a discount, and they're also helping an erstwhile ally. So that, you know, I think it might be hard to kill that flow. I think if you do find a peace deal or a settlement in Ukraine, that will allow Russian barrels to legally flow around the world again, which bizarrely may actually lead to an increase in price. Right now, the Russians have to sell it at a discount to China and to India. If they're able to sell it to whoever wants to buy it, that actually might end up, you know, sort of allowing them to sell it for more. And other grades won't have to compete against the Russian discounted grade. So there's that sort of weird thing as well. I do think there is also increasing pressure, particularly on India, to buy more from the US, not just crude, LNG as well, and also coal. So you'll start to probably see those flows increase quite a bit. Yeah, Indian refiners are actually fairly flexible, so they can take light oils. but that's not what they're getting from Russia at the moment. So it's not a straight swap out. So, you've always got to say, you've got to look at the quality of the crude and who can actually use it. And I think there's probably too much light crude already going into Asia, and that's what the Americans are really offering. So that becomes problematic, because does Asia need all the gasoline that you get out of light crude? And the answer is probably not.
Livia, again, the same question. Europe obviously would be at the epicenter of this idea of redirecting. They're the ones who have done the most of it after Russia's invasion of Ukraine, particularly on oil and oil products. Strangely enough, Europe is importing record levels of Russian LNG, which is a whole nother sort of mind twister of its own, and standing against the geopolitics of everything. But your thoughts on where Europe goes in this year, in which at some point a deal is done with Russia and redirection starts to be considered?
I'm glad you asked that question, because let's not forget that the reason why trade flows shifted back in 2022 was because of the oil embargoes. It had nothing to do with US measures of price caps, etc. And personally, even in the case of a peace deal between Russia and Ukraine, which, by the way, would take a long time, it's not coming overnight, we don't see Europe rushing back to lift the embargoes. It might eventually, but again, it would take time. So I don't think we're going to see a significant shift in trade flows on the Russian barrel specifically between Europe and Asia.
What about diesel?
Diesel, yes. Maybe that's a different story. Europe was very much dependent on Russian diesel, and the market where diesel has gone into are maybe less natural markets for Russian diesel anyway. I think one interesting perspective that we might also want to consider is from the Russian side. They have built pretty strong relationships with some of the new buyers of Russian oil now. Obviously, they didn't have much of a choice, right? They had to sell their crude to China and India. But if you're looking at it from a longer term perspective, that's where, if any demand growth is going to happen in the world, that's where it's coming from. It's not going to be coming from Europe. So why would you go and jump back into the European market? Obviously, there's a price question, but from a strategic point of view, you actually probably want to keep supplying those markets and keep those relationships going. There has also been long-term contracts signed as well, particularly with India. So I don't think you're going to go back to a situation where pre-war anyway.
Well, it's certainly going to be one in which money will determine everything. James, I wanted to get your thoughts on, if you wanted to pick up on any of that from the redirection of flows, but I wanted to particularly get your insights as a former leader and still somewhat of the British oil and gas industry, entrepreneur of the year, and so forth. Looking at what's happening with BP and Wood, two of the, Wood being one of the sort of great success stories of Scotland as on this oil services side, and BP, obviously the giant major, both sort of emerging in somewhat duress this last week. Your thoughts on that, and with it sort of the well, maybe the second part of that would be BP's sort of pullback, abandoning its transition commitments. But looking at the duress that the British industry, at least those two, are under, why? Is there common areas? What's the outlook for that?
Yeah, and let's try and get that into 30 seconds. Thanks,
yes.
Sean. So look, BP.
Is it just coincidence that they're both stressing at the same time, or is there some common ailment in the background?
No, I don't think there's a common ailment in the background between Wood's current situation. I think Wood's situation is more hardwired to the fact that, the big EPC contractors have been trying to work out how they service a changing energy landscape, both globally and indeed in the energy diversification or energy transition agenda. Obviously, the UK has been featuring very heavily in that space, which is why I said it's very hard to sum up in 30 seconds. Wood are clearly in a situation where they are trying to look out how they turn their business performance around, and as we know from Monday, the former United Arab Emirates potential acquirer has re-emerged on the scene to sort of like see whether or not there's an opportunity here from a distressed sales standpoint. So it'll be very interesting to see how that unfolds over the course of the next week. BP's situation is very different. They have found themselves marginalized in an energy world that has pivoted back towards the fossil fuel argument as opposed to the renewable energy argument. They had been taking a very strong leadership position in that. They have paid for that in terms of their share price. Their shareholders are driving them to make major changes, which are now coming out here. They're down 6% on a year ago. Compare that to Shell, who are up 6% on a year ago. I did say to you that the US majors are flat. Shell themselves looking at how they close the gap between themselves in Europe as a European major and the US major. So there's enormous changes going on.
Wouldn't the close the gap piece involve abandoning transition commitments and investing much more heavily in oil and gas production? Does that indicate even more supply?
Well, they've announced that. Yesterday, there's another, it's not in your press digest, but that BP announced what I think is a very significant deal, which is a $25 billion deal to go back into, to go more aggressively into Iraq and into the oil and gas fields there. So they're moving strongly into the Middle East market here earlier on. There's also noise in the markets just now, again, around the BP and Shell merger. To bring those two companies up to about the third level in terms of super major status behind Exxon. So, we are in an enormous
Actually, the stories I was hearing last night around one of the social events that the possible suitor for a BP would be one of the Gulf NOCs rather than one of the existing majors. Clyde, again, back to the outlook for demand, the somewhat plateauing of China. Where is the rest of Asia? That was certainly was peaking through the conversations this week. Can the other five in Asia pick up where the sort of shortfall in Chinese demand growth? But generally, the piece there is no. What are your thoughts on that and the outlook for particularly this year?
Well, if you're looking at the first 2 months, it will appear that overall Asia's oil imports have been more or less flat, maybe slightly down. I'll know more next week. But you haven't seen a particularly strong start to the year. Contained within that, there is a slight uptick in India's oil demand. I think India is probably your bright spot. But if you sort of translate that bright spot into actual barrels, you'd be looking at 250, 300,000 barrels a day would be a strong growth for India's imports this year. So that in itself is, it's good, but it's nowhere near what China was doing, when its economy was really accelerating. There you had China going up by 1 million barrels a day, for many years in a row. So India can't replace China. It's not the new China.
Well, the interesting piece of that also, just from the point of view of comparisons, where in China, generally 1% GDP growth translated into about 100,000 barrels a day. In India, it seems to be half of that. So 1% growth gives you 50,000 rather than what we used to get in China.
Yeah, and the other thing you've got to realize is that a lot of Asian countries are starting to go down the China road of electrifying their vehicle fleets. Initially, it won't make too much difference, and then suddenly, all of a sudden, it kicks in, just like it did in China last year, and you start to see big changes. So if you look at Indonesia, they're pushing very, very hard to get rid of all those motorbikes that are powered by petrol and replace them with battery motorbikes. Things like that. That starts to make a difference. It doesn't hit straight away. It takes a little while. So if you're sort of saying, the sort of whole China-led electrification of vehicles, which hasn't really factored in North America. It's not really a thing in Europe. They've got their own electric cars, but it's starting to really become quite dominant in Asia. And it's sort of changing things out here in a way that people in Europe and North America just aren't seeing. It is an actual game changer, and it will make it hard to be bullish on the longer term.
Well, as somebody said the other day, I think it was the chief economist of Trafigura, that even if it's 50% EV sales, that's still 50% of combustion engine sales, which in a country the size of China is still a very large number. Let's go to the survey question. Softer sanctions on Russia, harsher sanctions on Iran, new friends, old friends. Will those friends stay together? Softer sanctions on Russia, harsher sanctions on Iran won't impact oil flows in any significant way. Agree or disagree with that? Obviously, the bigger one there really Iran has a lot more at stake. One would think Russia was successful at getting around all the sanctions and somewhat of the flows. Iran was not so successful last time. Livia, we haven't mentioned OPEC Plus here. I wanted to get your thoughts on, obviously, OPEC Plus have a big decision to make about their April 1st. Do they or don't they proceed with their increases? They're going to have to announce that soon, maybe in the coming days. Your thoughts on what they're looking at in their crystal ball to make that decision?
We should probably hear something maybe next week of their decision. I think given all the uncertainty around what US policies is going to be on sanctions, on tariffs, because we haven't talked about that either, but that's a big question mark pending on the market as well next week. I don't think there's a lot of appetite to start unwinding production cuts in April. So I would personally be leaning towards saying they will delay, be it by a month or two maybe, which to be honest was always a possibility given we're still in turnarounds seasonally. We always thought that bringing back production in the middle of refining turnarounds wasn't particularly a great idea. So yeah, there is a possibility they will delay, but we probably will hear more next week.
We will. James, the other big event this week, which we're still, I mean, the headlines here in London IE Week, and they're sort of mirroring what's in the newspapers, you know, these very dramatic breakdowns and geostrategic fractures and stresses, yet the oil price is sort of in a parallel universe of I don't care. But your thoughts on the cumulative impact of these things? We had Macron in New York or in Washington this week. We had the Security Council, and for the first time in a long time, Europe and the US diverging. US engaging and with the same side of the table as Russia. Got the British Prime Minister going to Washington tomorrow. How big of a fracture do you think we're looking at here in terms of this historic partnership of Europe and the US? And from a very selfish point of view within the energy markets, should we have any concerns, or is there a intersection point?
Yeah, I think we are looking at a huge fracture. I think we're looking at a huge fracture in terms of the geopolitical arrangements, and as a consequence of that, we're also in the middle of a huge fracture in terms of people landing on where they sit in the whole energy transition landscape, and we touched on that earlier on. You know, you've got the US, Clyde and I had a little 30 seconds before we came online here, but you've got the US retracting back into being the US economy. We've got the Chinese Asia economy establishing what it wants to be, and then you've got Europe currently, in any case, a broken economy, you know, as a consequence of what's been going on over the last years, trying to work out where it sits. The breakdown in the relationship between Europe and the United States, and indeed Britain and the United States, it is not going to go away anytime soon. What you've actually got now is a situation where Europe has to work out what is its role going forward. And for me personally, I welcome this if you like, state that we find ourselves in now, because it compels Europe to try to work out what it wants to be, both in terms of the geopolitical world in which we live and the economic world in which we all have to live. And so I think we are going to see, I don't think it's unusual to see a British Prime Minister heading to the United States. And indeed, you know, over the sort of rhetoric that we used to live with around special relationships, that was always held up as a reason for probably lower class fares between the US and the United States. What is significant, I think, is the amount of time that we will see the British Prime Minister spend back with our old European partners, France and Germany, going forward. And that's what I'm looking for.
Well, we'll wrap it up there. I'll just add to that another comment or phrase. There's the result. Agree won't impact oil flows any significant ways. There was a comment on I think it was the S&P Global Commodity Insights presentation on Monday, where their head of oil was sort of discussing these topics, and he looked to the history books, as one must at times like this, when one forgets that things have happened before. And he quoted Lord Palmerston, the British Prime Minister of the mid-19th century, when Britain was at the peak of its sort of imperial powers, and the Prime Minister there sort of basically was stating, we don't have values, we have interests. The Europe has kind of a period of shared values, which has made the EU a glue of some sort. But we're now in the era of interest, and that's most starkly presented on the front page of the Financial Times this morning, where Ukraine and the US have done a deal on its mineral resources. I mean, my goodness, where's the values in that? You thought you were getting the money because you were defending democracy. No, you're getting the money because we want your minerals.
Sean,
so
Sean, if I just may, one thought for you to go forward as the week unfolds. Where does that go for the tech relationships that the United States has enjoyed with your own mother country, Ireland, as they seek to tell the big tech companies to repatriate revenues back to the United States? It is a state of wholesale change.
Yeah, interests rather than values. Clyde Russell, I value you. That's what I'll say. James McCallum, we value you, and all of you guys, and Livia Gallerati, we value you on this 998th Daily Energy Markets podcast. And we kick off our day here with the 8th London Middle East Energy Summit. And we're going to have 50 people walking through the door here in half an hour. And we will miss you guys and wish you all the best. Have a great day. See you soon.
Thank you. Congratulations to you, Sean.
Cheers, guys.